In today's video, we will discuss about debt mutual funds and find out how beneficial it is as compared to traditional fixed investment instruments like bank fixed deposits and post office schemes. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. Firstly, let's see what are debt funds, its types and how they are different from equity mutual funds. And in the later part of the video, we will compare its returns with bank fixed deposits. Also, we'll discuss about the pros and cons of investment in debt mutual fund as compared to bank fixed deposits. Debt funds are types of mutual fund that generate returns by lending money in the form of treasury bills, corporate bonds, commercial papers, government securities, and any other money market instruments to corporates or government agencies. As this form of lending is not directly linked to equity market, it has lesser volatility and the returns generated are not directly linked with the share market. Hence, considered more safer than equity mutual funds. Depending on the lending duration and type of borrowers, the funds can be classified as follows. First, long to medium duration debt funds. This type of funds invest money in instruments and securities with maturity horizon between 4 to 7 years. Second, medium duration debt funds. This type of funds invest money in instruments and securities with maturity horizon between 3 to 4 years. The third one, short duration debt funds. This type of funds invest money in instruments and securities with maturity horizon between 1 to 3 years. And the fourth one, liquid or ultra short term funds. This type of funds invest money in instruments and securities with maturity horizon of less than 90 days. There are also other categories of debt funds like fixed maturity funds, corporate debt funds, credit risk funds, gilt funds, dynamic debt funds. But in today's video, we will compare only above 4 types of funds. For comparison, I have taken rolling returns of 2 top rated debt funds from the respective category and compared with the average nationalized bank fixed deposit rates. The FD rates have been taken for the duration of fixed deposit at the time when the fixed deposit was done. For example, if you have done FD in 2015, that is before 7 years, for a period of 7 years, the rate of interest would have been 7.75%. Now let's look at the long to medium duration debt funds. On comparing the returns of long to medium duration debt fund for the period of 3 years, 5 years and 7 years, it is evident that it is able to beat the FD returns, but the margin is very low, say less than 0.5%, whereas when compared for 1 year, it is not able to beat the FD returns. Here also keep in mind that the returns of debt fund are not linear and has a volatility of plus or minus 1%. Hence, the effective return may vary depending on the time of redemption, and sometimes it can also happen that it may be lesser than that of a fixed deposit. Now let's look at the returns of medium duration fund. Here also it is same for 3 years, 5 years and 7 years. It is able to beat the FD returns marginally, but for 1 year duration it is not able to beat the FD returns. For short duration debt funds, the returns of 3 years, 5 years and 7 years is as comparable to that of a FD, whereas for 1 year it is not able to beat the FD returns. For liquid to ultra short term funds, the return is little bit higher as compared to the saving bank interest. But keep in mind that the saving bank interest up to Rs 10,000 in one financial year is tax free, whereas there are tax implications on returns of debt funds, and also there is an exit load applicable on debt funds in some cases. So before coming to the conclusion, let's see the risk associated with debt funds and also the tax implications. The first risk is the credit risk, wherein there is a possibility that a borrower may not return the principal and interest on the agreed date is termed as credit risk. There are agencies like CRISIL, ICRA, etc. which provide credit ratings for a borrower. Generally, with a better credit rating, the interest rate is lower and vice versa. But a higher credit rating does not guarantee that the borrower will not default. The second risk is interest rate risk. The RBI interest rates and bond market price are inversely linked. Hence, if one increases, the other decreases. Hence, when RBI increases the interest rate, the bond prices fall and eventually the return of debt fund also falls. The third one is the inflation risk. The performance of bond market is directly linked to the performance of the economy, and whenever there is an inflation, RBI will try to control by increasing the interest rates, which negatively impacts the bond market, and debt funds returns are also hampered. The fourth one, that is liquidity and redemption risk. Due to sudden redemption request from many investors, the fund house is not able to generate the required money by liquidating the held securities, as it becomes difficult to sell huge quantity of securities in the market. This is termed as liquidity or redemption risk. The example of Franklin Templeton in 2020 is a clear example of this risk, and eventually the fund house had to close 6 of the debt fund schemes. As you have watched my video till now, it seems that the topic is of your interest. Hence, I would request you to hit the like button and show your support, which will help me in creating such useful videos in future, and also subscribe to my channel to not miss such interesting videos. Now coming to the taxation part. Gains from debt mutual funds are categorized as capital gains, whereas the income from fixed incomes is categorized as interest income. Hence both this type of incomes are taxed differently. In debt funds, if the investment is withdrawn before 3 years, that is 36 months, then it is termed as short-term capital gains and is taxed at the rate of applicable investor's tax rate. Whereas if withdrawn after 3 years of investment, that it is termed as long-term capital gains and is taxed at a flat 20% with indexation benefit. In both the cases, tax is applicable only at the time of redemption. For bank deposits, the income is considered as interest income and is taxed at the rate of investor's tax slab. Even if the duration of fixed deposit is more than 1 year, the interest is added to the investor's income on a yearly basis. Some people consider this as a con, because even though the money is not coming in your hands, but the income is added and tax has to be paid. I would consider this as a positive, as every year you get a part of the income of the total income instead of receiving the total profit at the end of the period as in debt funds. Here, as you are getting the income, that is the profit, in parts, every year it becomes easier to adjust the taxable income and save on taxes. Now coming to the conclusion, let's also take following points into consideration. First, creating a debt fund portfolio is quite complex compared to equity fund portfolio, especially selecting the type of fund and its allocation in total debt portfolio, whereas investing is quite simple in fixed deposits. The volatility of the NAV can be a concern as it directly affects the total returns, which in turn would stop a person to withdraw funds from the debt fund and hamper the overall liquidity of the debt fund. The returns of debt funds are marginally higher as compared to FD, but the difference is so negligible that I feel it does not make sense to take the additional risk. Instead, I would prefer to invest in bank fixed deposit. I also feel that except equity mutual funds, no other type of mutual funds are worth investing. You can check my earlier video of balanced mutual funds for the monthly income. Link is attached above. The other option to bank deposits are post office schemes. In my upcoming video, I will be showing you how by combining more than one post office schemes you can earn better returns. So stay tuned. To watch my earlier videos, do click the links in the attached cards. Thank you.